You know, when you trust someone with your money, you just assume they have your back, legally speaking, right? But what if they don't? When it comes to financial advisors, the rules are surprisingly complicated. So today, we're going to pull back the curtain on what those rules are so you know who you're really trusting.
All right, so let's just start with the big question. You meet someone, they call themselves a financial advisor. Are they required by law to act in your best interest? Well, the answer, pretty shockingly, is it depends. Yeah, it depends on their specific title, what license they hold, and even what you're talking about in that exact moment. And that confusion, it's right at the heart of our entire financial advice system.
So to really get why the answer is so messy, we've got to look at where these rules even came from. And it turns out they didn't just come from one place. They actually grew up on two completely separate parallel tracks, which created this split system that's still with us today. Let's hop in the time machine for a second. Way back in the 1930s, regulators created two different lanes for financial advice. In one lane, you had stockbrokers, and they were governed by what's called a suitability standard. In the other lane, you had investment advisors who were held to a much, much higher fiduciary duty. And for 80 years, these two systems just existed side by side until a 2020 rule called Regulation Best Interest finally came along and tried to build a bridge between them.
So what's the actual difference between these two standards? Fiduciary, suitability, what do these words even mean? Well, the easiest way to think about it is to imagine two different professionals. One is like your doctor, who has taken an oath and is sworn to act in your best interest. The other is, well, they're more like the salesperson. Their main job is to sell you a product. That's appropriate, sure, but not necessarily the very best one out there for you. Okay, let's get specific. A fiduciary duty, that's the gold standard. It's all about trust and confidence, and it legally requires an advisor to put your interests first, always. The suitability standard, on the other hand, is totally different. It's more like a commercial sales transaction. The recommendation only has to be appropriate, which means there could easily be a better, cheaper option that they have absolutely no legal obligation to even mention to you.
And this is where you can really see how the incentives just go in completely different directions. A fiduciary relationship is typically ongoing and fee-based, so their success is aligned with your success. But a suitability relationship, that's often just about that one transaction, the point of sale, and it's usually commission-based. Those two different ways of getting paid create completely different motivation. Okay, so regulators recognized that this huge gap was a massive problem for investors. So in 2020, the SEC introduced something called Regulation Best Interest, or Reg BI. This was their big attempt to raise the bar for brokers and try to bring these two standards a little closer together. Now, this is maybe the most crucial point to get. While Reg BI is designed to make brokers act more like fiduciaries, it is explicitly not a fiduciary standard. It's an enhancement, it's an upgrade to the old suitability rule, but it does not replace it with that highest standard of care. It's better, but it is not the same thing. And trust me, that distinction matters a lot. So Reg BI has four main requirements for brokers. First, disclosure. They have to tell you about all the important facts, fees, and any conflicts of interest. Second is care. They have to exercise diligence and actually believe their recommendation is in your best interest. Third, conflict of interest. Their firm has to have policies to manage things like sales contests that might push certain products. And finally, compliance. They need to have internal rules to make sure all of this is actually being enforced. All right, now we get to what is hands down the most confusing part of this entire system. This is where so many investors get tripped up. It's what I call the advisor with two hats. You see, a ton of professionals today are what's called duly registered. This means they're licensed as an investment advisor who has to act as a fiduciary, and they're also licensed as a broker who operates under that lower Reg BI standard. They can literally switch hats in the middle of a conversation. One minute they're giving you a financial plan as your fiduciary, and the next they're selling you a mutual fund as a broker and earning a commission. And the research shows most people have absolutely no idea when that switch just happened. This table really lays out the whole landscape. On one end, you have an independent RIA, who is always a fiduciary and is paid only by fees. Simple. On the other end, a traditional broker-dealer, paid by commissions. But it's these hybrid models in the middle where things get so tricky. That's where an advisor can switch hats, earning both fees and commissions. And it's where those conflicts of interest can really hide in plain sight.
So, why does all this legal jargon matter so much? Well, because the difference between these standards isn't just theoretical, it has a massive, measurable impact on your wallet and your ability to build wealth over your lifetime. This quote just says it all, doesn't it? The legal standard your advisor follows has a direct line to your financial outcome. Conflicted advice, where a professional has an incentive to sell you a high-commission product, can have absolutely devastating effects. Let's put a real number on this. Imagine you invest $500,000. In a low-cost fiduciary advisory account, your first-year costs might be around $5,500. But if that same money goes into a high-commission brokerage product, those first-year costs could be as high as $31,000. That's a difference of $25,500 of your money gone in the first year alone. Okay, now let's see how this plays out over 20 years. The impact is just staggering. With low fees in that fiduciary account, the $500K grows and compounds beautifully. But when it's constantly being eroded by high commissions from conflicted advice, the final portfolio value is dramatically smaller. That gap between those two bars, that isn't just a number on a chart. That could be your retirement. I know, this can all feel pretty overwhelming, but the whole goal here is to empower you. Regulators are trying to protect you, but your best line of defense is always going to be yourself. So let's build your toolkit. The single most important takeaway here is that you have to be an active, informed consumer. Simply understanding these rules we've talked about allows you to ask the right questions and demand the standard of care that you and your money deserve. So here they are, the 5 essential questions you should ask any financial professional right from the start. Number 1, and this is the big one, are you acting as a fiduciary at all times when working with me? Then ask, how are you compensated? Do you earn commissions? Make them spell it out. Ask, what are all the costs associated with my investments, including any internal fees? Ask, what potential conflicts of interest do you have? And if they're one of those duly registered advisors, make them explain exactly why they're recommending a brokerage account over an advisory one, or vice versa. Look, the rules governing financial advice are complex, and the lines are often blurry. But now you know what to look for. You know the difference between a fiduciary and a salesperson. You know about the hot switch, and you know the devastating costs of conflicted advice. So the only real question left is, are you ready to ask the right questions?